Okay, this section is section D of chapter 9, and we are on page 7. Look at deferred income tax for consolidated entities. The first thing we need to do, though, before we look at that, is revisit what deferred income tax is from what you guys learned in 316. So, as you know, deferred income tax arises because of differences between accounting income and taxable income. And you covered that in detail. There was a whole chapter in 316. Now, the same kind of thing happens in this combination. Now, remember that for tax purposes, CRA looks at each company's files separately. The parent and the sub are separately going to be assessed for tax. So what we're doing is just trying to figure out what the balance should be for consolidated statements. So let's just do a view of DIT or FIT. So it's either deferred or future income tax. So basically we're trying to reconcile the difference between the accounting income and the taxable income. So that's our whole goal with DIT or FIT. So on page 8, I've got the rule from this text. Now every text and really every accountant has their own little way of figuring out deferred income tax. So you can read through this. Or just review your 316 notes. Chapter 18, I think. And just get an idea of how DIT or FIT works. Usually the way you do the rules works best the way you've learned it. Now, that said, I'm going to lead you through the way I teach it. So hopefully it doesn't confuse. If it does, just ignore it, figure out your own way, and come up with that. So let's go through example 5. Sorry about this, you guys, the autofocus sometimes. Okay. For each of the following examples, states whether a DIT asset or a DIT liability will arise from the difference. Calculate the amount and explain. Just so you know, I will never ask you to explain on an exam. Tax rate's 40%. Okay, so 3,000 in unearned revenue, so no revenue was recorded during year 5. So that's for the accounting purposes. Tax rules require that revenues received in advance are taxed when received. So basically, if you remember, tax rules are generally about cash. Either received or paid, generally. So, if we write down a little kind of chart, what's on our books and what's for tax purposes. And I'm going to look at it from a revenue expense perspective, except when we talk about equipment, because that one you can look at your way. But I generally tend to look at the income statement and think about it that way. So, for revenue, how much revenue did we record on our books? Well, it's all in unearned, so we got a bunch of cash that we debited, so we credited unearned, so we didn't record any. For tax purposes, we got a bunch of cash, so it's going to be taxed when it's received. So we've got 3,000. So received, so taxed. The difference is 3,000, and you times it by the tax rate, get 1,200. So that's the easy part. Then you've got to figure out if it's a DIT asset or a DIT liability. So because we're trying to reconcile accounting income with taxable income, and these differences are going to reverse in the future. You're looking kind of at future you, okay? So future you compared to now, are you going to pay more tax or less tax on this transaction? Well, right now you paid all the tax on this transaction. So future you doesn't have to pay tax. Accounting will record revenue, but for tax purposes you won't, so you'll be happy. So future you pays less tax because already paid this year. So future you is happy, therefore this is a DIT asset. Okay, now drawing a little happy face isn't really accounting terms, but you don't do this a lot, and especially when you're learning. Find a way to think of it that makes sense to you and then go with that. Okay, so let's do the next one. The balance in prepaid expenses is $5,000. So what does that mean? It means we credited cash, but did we expense anything? No, we debited prepaid expense, which is an asset. Tax rules state that it's tax deductible when paid, so they reduce taxes when they're paid. So again, we're going to set up the same thing, our books and tax, and this time we're focusing on expenses. So on our books, did we record any expenses? Nope, it's all in prepaid. Were we able to deduct any expenses? Yes, because we obviously paid $5,000 in cash, so we've got $1,000. So again, the difference is 5,000 times 40%, which is 1,000. And you have to figure out, is it a DIT asset or liability? So future you, because this is all about future you. Are you going to be able to deduct any more on this transaction in the future? This future you're going to be able to say, ooh, I can tax paid because I have some this transaction left over. It all now. So future you has nothing or no expense to for tax purposes. So how does that make future you feel? Not happy, so that means it is a DIT liability. Hopefully that makes sense, you guys. If not, I seriously encourage you to go back and look at 316 in your notes. Bear in mind, you guys, this is a small part of the final, but it's just a no anyway for CPA, and this comes up all the time. So it's a good thing to kind of review. Okay, the book value of equipment is $12,000. The UCC, or undepreciated capital cost, is $14,000. So again, we can do the same thing. Books, tax, and looking at the balance sheet. So the balance of the asset. So on the books, it's $12,000. That's our book value. And the undepreciated capital cost is $14,000. So again, the difference is easy. It's 2,000 times 40%, which is 800. The question is it an asset or a liability? A future or deferred income tax liability or asset? So, future you compared to accounting. Are you going to be able to lower your tax more than the accounting person? Yes. So, future or in the future, the tax basis has more balance available for expenses which decrease taxable income. So that means you're happy. The accounting guy only has $12,000. You get to deduct $14,000 in the future. So you're happy. So that's a DIT asset. Okay, part D on page 9. So the balance in AR due to installment sales. So installment sales, if you remember, is from an accounting perspective, we record the revenue now, get money later. And there's all kinds of rules. Obviously, there has to be a reasonable expectation of being paid and receiving the money, things like that. So payments can be received on these sales over the next 2 years. Of course, tax rules are all about the money. Revenue is taxed when it's received, so when they get the cash. So for the books and the tax basis, and we're looking at revenue here. On our books, we had $25,000 of revenue this year. Did we get any cash? Nope. No cash received. So we weren't taxed on it. The difference is 25,000 times 40%, which is 10,000. So, again, is it a DIT asset or DIT liability? Well, in the future, is future you pay more tax or less tax because you're getting money in the future? Well, right now you didn't pay any tax on this transaction. In the future, you're going to get this cash, right? So future you is going to have to pay tax on it. So future you will pay tax on the 25,000. So you're not happy, so it's a DIT liability. Now, finally, the balance in warranty liability, and we're using the expense approach. If you remember from 316, there was an expense approach and a revenue approach. Generally, your questions on DIT are going to be on the expense approach, although technically you can do the revenue approach. It's still a new concept. So the warranty liability using the expense approach is 9,000. So we have had warranty expense is 9,000. Tax rules say that warranty expenses are tax deductible only when the cash goes out. So that's going to be in the future. So books, tax, and this time we're dealing with an expense. So on our books, we said 9,000 warranty expense. Tax, we said 0. So the difference is 9,000 times 40%, which is 3,600. And the question, is it a DIT asset or a DIT liability? Well, in the future, and remember we're comparing to accounting all the time. So future you, did you get to deduct any tax here? Expenses for tax purposes? No. Today. But in the future, can future you do that? Yeah, when you start paying these warranty costs, you can deduct them. So future you is happy. So in the future, more tax deductible expenses. So you're happy, which makes it a DIT asset. So taxable income goes down. So hope that little review made sense, and you can look at your text in 316, your notes, if it doesn't. Okay, that's it for reviewing DIT. And the next video we'll do the second part with